Okay.
Okay, so good morning, everyone. I think this is good morning. But before I go into the training for today, I just want to say to all members again that if you are yet to get your demand notice for the 2021 calendar year, please reach out to me privately. You can send me a message or send a message on the group so that we can rectify that. Demand notices have been sent to all members. And so if for any reason you haven't received your demand notice yet, please reach out to me. If you also have friends who are members of the district, please reach out to them and let them know that we all have a responsibility to contribute our quota to the district. Okay, so this morning we're going to be looking at the Road Infrastructure Development and Refurbishment Investment Tax Credit Scheme, which was by an Executive Order number 7 of 2019. During the week, a material was shared on the group by the PRO, and so maybe either by show of hands or by commenting in the chat box, if you have either gone through the material or even before now, if you have seen that material and you have reviewed it, can you please let me know? Can you just type yes in the chat box or raise your hand so that I can see and I can get a sense of the level of familiarity we have with the subject matter? So if you've read this document before or read the document that was shared, at any point in time, I can see one hand up. See, I'm seeing one hand up. In the chat box, you can just type yes if you can't access the option to raise your hand. So I'm seeing, okay, so only one hand up. So I take it that most of us here have not gone through the document. So it means that this will basically form a sort of research light into this area. And after this training, we might have to just go back ourselves to even do a detailed dive into the document. So it's a very short document, about 21 pages. And I believe if you dedicate about 30 minutes to 45 minutes, you can adequately cover it. Now let's talk about the infrastructure gap in Nigeria. The Vice President, His Excellency Professor Yemi Osinbajo, was quoted to say that Nigeria needs $3 trillion over the next 30 years to solve its infrastructure problems. The Minister of Works and Housing says that Nigeria needs 500 billion naira annually for the next 3 years to develop and fix road networks across the country. And this was just a couple of months ago in November 2020. Now, what exactly is infrastructure? What is infrastructure? Infrastructure is basic physical and organizational structures and facilities needed for the operation of a society or an enterprise. So if you want to start a business, if you run a country, there's certain things that you need. So infrastructure, as you can see in the image beside us, infrastructure goes from roads to airports, to seaports, railways, power and energy infrastructure, water utilities, education, healthcare, social services like stadiums, and the likes. This particular document focuses on roads, and it is in the right direction because about 90% of passenger and freight movement across Nigeria is done by road. So I know most of us in this group probably frequent travelers by air, but a lot of the commerce and movement in the country still happens by road. So 90% of that happens by road. And we also know that roads have a developmental effect in the sense that, it creates channels, it creates access, it links communities, and wherever communities link, there's trade, and wherever there's trade, there's prosperity. And so roads are a very, very important part of the agenda. So what the government has done is to come up with a scheme that would is expected to improve the infrastructure stock of the country over the next couple of years. And so in this training today, I'll take you through a high-level executive summary, meaning if this is all you get from the training, if you focus on that slide, you have the whole idea of what we're talking about. We talk about the committee to administer the scheme, a couple of definition of terms. We look at the infrastructure tax credit certificate, look at eligible roads and participants, and of course, matters arising and questions that we have. So this is a digital training. So just to be sure that everybody is following and hearing me, if you can still hear what I'm saying, can you just type yes in the chat box so that I can be sure that we are all together and my connection hasn't tripped off? Can you just type yes in the chat box so that I can know that we're all following? Okay, great. I've seen one response. Okay, 2, 4, 5. Okay, fantastic. Okay, great. So we're all following. All right, thank you very much. I appreciate that. Okay, so I said the executive summary, if this slide basically, summarizes everything that we're about to talk about. So there have been complaints about the state of roads, and I'm sure that within your vicinity, you don't even need to travel more than 1 kilometer for you to find a road that needs some work or either even needs to be built in the first instance. And then there has been a high demand for road construction projects by companies and corporate sponsors. And in some cases, people have gone ahead to even fix these roads by themselves. But what a lot of people have found out is that when you try to fix a government road, the government reminds you that a road is a public utility and it is not yours. You can't just handle it how you want. And so people have been asking and clamoring that, is there a way we can fix some of these public utilities and claim some form of benefit back from the government? Also, as we know, there are challenges in funding the national budget. And so, there's a need to come up with more creative ways to finance, the government projects. And this is one of them. And so because of that huge gap in infrastructure, there's a need for creative ways. The Road Infrastructure Development and Refurbishment Investment Tax Credit Scheme is a PPP, meaning it's a public-private partnership that enables the private sector to fund construction of the roads, and they can get a tax credit back from the government. So this scheme was brought into existence in January, on the 25th of January, and it's supposed to last for a 10-year period. So it means this is valid from January 25th, 2019 to January 24th, 2029. Basically, the whole idea is you fund a project, and say the project cost is 1 billion. The government gives you an uplift, meaning an additional or maybe a profit margin for the case of this, which is equal to the MPR, the monetary policy rate, plus 2%. And you can claim that. So currently the MPR is about 11.5%. If you add 2% to that, you have 13.5%. So you spend 1 billion naira on a road, you get an uplift of about 135 million uplift, and then you can claim that as a tax credit against your CIT, in this case only on CIT payable to the government, right? And so that's the high-level summary of what we are discussing here today. But let's get into more details. The document actually of course, has to designate a committee that will be responsible for administering this scheme. And so the executive order specifies that the committee will be made up of a couple of people, the Minister of Finance, for one, being the chairman of that committee, the Minister of Works being the deputy chairman, the permanent secretary of the Ministry of Finance as the secretary, and then we have other people from Federal Inland Revenue Service, the Bureau of Public Procurement, Nigerian Investment Promotion Commission, Securities and Exchange Commission, SEC, ICRC, the Infrastructure Concession Regulatory Commission, the Budget Office, the National Bureau of Statistics, the Nigeria Sovereign Investment Authority, somebody from the Office of the Chief of Staff in the Presidency, and someone from the Ministry of Justice, someone from the Ministry of Industry, Trade and Investment, and any other persons as may be deemed fit by the Federal Ministry of Finance. And so you see it's a wide and fair committee to be in charge of this scheme, and basically will be responsible for the administration and implementation of the scheme. Document elaborates, all the functions, but I'll just be highlighting a couple of items. They will be facilitating the publication of eligible roads, so look at what eligible roads are. And then they also publish a list of documents to be submitted by the applicant. So from time to time, they let you know that, okay, what do you need to submit if you want to participate in this scheme. They will review and evaluate applications made. They also review approvals of project costs and also completion timeline. And then they also recommend projects that will be certified for you to get your tax certificate. Right. So a couple of key definitions. Right. In the document, it talks about a participant, and basically a participant in this scheme is anybody who decides to go ahead to pick up one project or would like to sponsor a project. And in this case, it can be any corporate body or a group of corporate bodies, except a sole corporation. And they can come together or form a pool of investors to decide to fix a particular road. So if, for example, we want to fix the Ikorodu road, for example, a single company, Mr. XYZ Limited, can decide to do it on its own, or it can come together as a group of companies with a fund manager to decide that they want to fix that particular road. And then the beneficiary is the person who utilizes the tax credit scheme. So interestingly, this scheme allows you to sell your tax credits. If I have the initial scenario that I raised, if I have a 1.3 billion naira tax credit certificate, I can sell it on the relevant exchange and get some cash for it, rather than waiting to claim it off my CIT return. So the beneficiary is the person who actually utilizes that tax credit certificate. Disposal, as with my from the committee and the Minister of Finance, and those are the roles that you can apply or bid for to work on under this scheme. We also have the relevant securities exchange. These are the exchanges on which you can trade your instruments, where you can sell your tax certificate and other people can buy from you over the counter or on official exchanges. Project cost is the amount that is expended solely on that project, and the document specifies clearly some of the items that will form part of the project cost, and some of them include consulting fees for lawyers or project managers. So I'm going to read the cost of the road construction or refurbishment. Professional service fees paid to a fund manager or a project manager, or contract lawyers or engineers or professional services. Cost of maintenance of the roads, and all those things. But it also ensures that if you are dealing with a contract that is over 10 billion naira, these associated professional fees cannot be more than 1.25% of the project cost. So it's an interesting document, and like I said, I encourage all of us to really dive into this to get into detail. Let's look at how basically it works. So you, like I said, you invest your 1 billion naira in this project, and then when you complete it, you get an uplift. So now you have the 1.35 billion tax certificate that you can either use to offset your company's income tax liability, or you can sell it. The interesting thing is that after you construct the road, it has to be certified by the committee. When it is certified by the committee, the FIRS, that's the Federal Inland Revenue Service, will then need to issue you a tax certificate. And it is only when you receive that tax certificate that you can begin to trade it or use it to claim your tax credit. Now, it is said that FRS has 14 days to give you that tax certificate after the committee has approved such projects, right? So in order to use this credit, it has to be approved by FRS, and this approval will be done on an annual basis. So if it's a multi-year project, the value of work certified for a particular year is what you are entitled to claim a credit on. So if you're dealing with a project that is 3 years, each year the committee will certify the work that you have done, and FRS will issue a certificate for that, and you can actually trade that certificate, right? Now, however, there's a limitation to how much of the tax credit you can use. For this scheme, you can only use 50% of tax credit. You can only use it to offset 50% of your CITP. You can't offset your entire CITP, except you're dealing with a road that is built in an economically disadvantaged area. So if you're dealing with a road that is built in an economically disadvantaged area, you actually can use 100% of your tax credit to offset your CIT liability, right? And so the next question would be, what is an economically disadvantaged area? And the document also goes ahead to explain that the Minister of Finance would have to consider whether the average income level of the inhabitants of that area are below the minimum wage, whether there is availability of infrastructure such as electricity, water, sewage, telecommunication, transportation facility, whether the volume of nature and activity being undertaken in such area is significant, and other factors that might be considered necessary by the Minister of Budget and National Planning. So if you invest in a road project that is in an economically disadvantaged area, then you are allowed to claim a whole 100% of your tax credit on your CIT payments. And if you do not utilize it, you can carry it forward, and this credit can be carried forward indefinitely. Like I said earlier, you can also sell it to a third party on a securities exchange and get cash for that investment. And in the books, you should also recognize it as an asset in your books. I think I'll need to leave this part for the financial reporting experts on how we treat it given IFRS 9 in terms of financial instruments. So how do we report this as a deferred tax asset, or whatever that is. I'll leave that to the financial reporting specialist. But you're allowed to recognize this in your books as an asset, but you cannot claim you can't claim capital allowance on this particular investment. So this 1 billion that you have spent on the road, you can't claim capital allowance on it. Now let's see a couple of participants. So this scheme came into use in 2019, and there have been a couple of eligible roads. So initially there were about 19 eligible roads, and a number of companies that have also signified interest in and have started participating in this scheme already. You have Dangote, you have Lafarge, you have Unilever, Flour Mills, NLNG, and the China Road and Bridge Corporation. And some of the eligible roads are the roads you can see: the reconstruction of the Benin-Gwari Express Road in Kaduna State. And for those of us in Lagos, we know the popular Apapa Oworonshoki to Ojota Road. So around, if you have passed the Bagada Axis, anytime recently, you'd have seen that the construction work is going with concrete roads, and that is one of those projects that is being constructed under this particular scheme. I think it's a partnership between Dangote and Flour Mills, and that is one of the projects that is under this scheme. Now, when COVID hit last year, the Office of the Vice President and the other economic advisors sat down and came up with an economic sustainability plan. And one of the agendas in that sustainability plan was that in order to increase the infrastructure in the country, they will broaden the utilization of this road investment tax credit to ensure that we have more eligible roads, and they incentivize small companies to come, and take some of the roads that are being listed. And so basically how it works is, if you see a road that is of interest to your company, you can either lobby for it to be part of the eligible roads, or if it is already on the list of eligible roads, you can actually, select one of those roads to be part of the roads that you want to fund under this project. So once again, I've been talking for quite a while, just again to be sure that the connection hasn't gone off. Let's do our regular. Please just type a yes in the chat box so that I'm very sure that, okay, that my connection is not fantastic. So this is our new normal. Because we're not in a regular class, I can't see, or I will not know if my connection has tripped off. So we need to be doing this from time to time. Please pardon me. Right. So these are some of the eligible roads and the companies that have participated in this scheme. So there are some matters that have started coming up as a result of this scheme. The first thing is, last year alone, the CIT receipts that FRS collected was about 1.4 trillion. And so what is basically saying is that the maximum claimable in a year of your tax is about 1.4 trillion. So that in a sense, that kind of gives you a cap on what the market size of that kind of investment will be. So basically, if we have a situation where the roads that are constructed are more than the 1.4 trillion benchmark, there might be actually no CIT revenue for the government. And this is because this kind of scheme ranks higher than other debts that are even secured by an ISPO, because this is a first line charge, even before the revenue gets into your pocket, right? The payer will say, oh, I already have my credit and I do not need to pay this money. So we can have a situation where, because of this infrastructure investment, there's actually no CIT revenue payable to the government. Another thing is that MPR is currently 11.5%. If you add a 2% uplift at 13.5%, is that attractive to an investor considering the cost of capital, right? So is it a good investment for me as an investor to get a single uplift, not a multi-year uplift, of only 13.5% if I consider the risk and all the effort that is required for this kind of project? Is it going to be attractive to me as an investor? And then, considering the fact that companies' income tax is shared by all the three tiers of government, would it be only federal roads that are, that can be eligible roads under this scheme? And then, when we looked at the criteria for economically disadvantaged areas, we talked about telecom facilities and all of that, but the criteria was not objective. So we used to score areas to know whether they're economically disadvantaged or not. And so, apart from the 19 roads, and as I said, in line with the economic sustainability plan, we still haven't seen or heard more information on the additional roads that are being added to this scheme for people to signify interest. And then we also have issues where there might be delays in confirming this. So if you want to trade your tax certificate on the exchange, there might be delays between FIRS communicating with the exchange to dematerialize that certificate and turn it into a digital tradable instrument. And so it might keep the holder of a tax credit waiting for so long for him to sell it to another party. Another issue is that Nigeria's track record on PPPs haven't been very encouraging, and people might be wary to go into this. And then another interesting proposition is that, could this create a window for companies to trade other things like their unutilized capital allowances or their withholding tax credit notes? And so if I have a credit note with the FIRS, since we can trade road investment tax credits, can I trade other credits that I have with the FIRS? And it'll be interesting if those kind of things, become possible in the nearest future. And so this brings us to the end of my presentation. And at this point, we have questions or further discussions on the topic.
Thank you very much, Mr. David Apaflo, Chairman of Education and Training Committee, for that wonderful presentation. I'm sure a number of us, it has shed light on the road infrastructure credit, of the federal government to a number of us. I'm sure a number of our members they have seen it before, but this presentation has simplified the whole thing. And I'm very sure we have people that will want to ask questions, including me. So let us give our members opportunity to ask questions. Please, you can do this by show of your hands so that we will be able to get Mr. Paflo to respond to the question. While we're waiting for people to signify and show hands, I will go ahead and ask my own question. First of all, I was delighted to see your matters arising, because a number of things that were in your matters arising were the things I've already jotted down that I was going to ask questions on. But of course, I saw in the second to the last slide that you presented, I was able to tick off some of them. However, I still have one or two which I'm going to ask. In as much as we know that the way they're offering to people that are interested in this scheme is not attractive at all, because going by the fact that you're going to incur this money now, and you even have limitations on how it can be utilized over a period of time. So now the question is, when you have the investment, the road infrastructure credit, rather, when you have a credit and you said it could be traded on the exchange, then my question is, how will that work? Is there fractionalization? I have 1 billion naira in road infrastructure credit. I want to trade it on exchange. Do I need to look for the person that will buy the entire 1 billion, or there's opportunity to sell 100 billion out of it to one person, sell 50 to another person? And if yes, how will this work? And the modalities for this, to be seamless, and for there not to be leakages to give avenue to frauds and other irregularities. That's my question, basically.
Okay, so just go to answer it. So the document does provide for fractionalization, meaning you can split the tax credit between other beneficiaries. So a participant can actually split. In fact, the first split that is recognized is that a pool of investors come together to invest in an asset. You can even issue the certificate to each of them based on their level of contribution into that fund. And then even when you are trading your tax credit certificate, you can actually sell it in bits based on what is unutilized, or based on the demand that a particular customer or counterparty has. Now, how would it work? I want to believe that it will work similar to the way promissory notes are currently traded on the FMDQ exchange. So typically what happens for government promissory notes is that a contractor goes to a bank to say, okay, the government, I've done a contract for the government of say 1 billion, and the government is owing me, but I want to discount, or I want to sell off these promissory notes that the government is going to pay. And so what happens is that the bank writes to the debt management office, to DMO, to say, please confirm this promissory note that the contractor has presented to me, and give us approval to dematerialize this hard copy certificate to a digital copy, to something that we can trade on the FMDQ exchange. And so typically what happens is the DMO responds, and then that certificate or the promissory note becomes dematerialized, and it becomes a security on the exchange, and then you can buy and sell that security among parties. But then the initial holder of the promissory note gets value today for his promissory note. So I want to believe that it will work similar to this. We haven't seen much more guidance from the committee on this area, but I want to believe that it will work similar to the promissory note scheme.
Thank you. Who is raising hand? Please, you can unmute yourself. Ask the question.
Okay, thank you, Chairman. Thank you, Mr. Apaflo, for that lecture. So I just want to not a question really, but the matter arising, issue relating to government having or not having CIT at the end of the day. The idea of, I think one of the idea of the order is to ensure that infrastructure are developed. And then it's rather than putting the money in the hands of government directly. So we have people who can invest in infrastructure directly. And so whether the money is coming through taxation, CIT into the government coffer, or somebody has used it to construct a road or to repair the road for the purpose of the public, then it makes the same purpose. So I think that aspect of CIT, government having CIT or not having CIT, is part of the issue. The order is trying to resolve, just to ensure that infrastructure are developed, roads are developed directly, rather than putting it in the hands of government. And by the time you pay such, for example, if you pay such 1.4 trillion as tax, I'm telling you, even if the purpose is earmarked for road construction, at the end of the day, you are sure that what you will get for the construction of road may not be up to 1.4 trillion, because it will have passed through a lot of hands. But if an individual person, a company, is utilizing that money directly, and the committee are going to vet that and ensure that FRS is going to look critically into such project, then you see that we'll have more infrastructural development than paying the money directly as CIT. So that's just my take on that issue.
Okay, so I like the take, but then you need to consider the fact that in the government's budget, it is not only road infrastructure. In fact, under infrastructure, road is just one type of infrastructure. So if you use 1.4 trillion alone on roads, then other areas, other sectors in the government budget are likely to suffer. So it's just one thing that we need to consider. So yes, it's good. We would most likely have roads, but then it creates its own externalities because other sectors might not get enough funding. So thank you very much for that.
All right. I'd like to address Ogundipe Olabisi's comment. He said the scheme is a very laudable one. There seems to be a lot of disadvantages to both the state and the local government, in that the road is only for federal roads. Taxes that is supposed to be received at the center and shared to both the state and local government are not received. Okay, kindly allay Matthias. You may want to address that.
Okay, so this is one of the things that we mentioned. That first of all, CIT revenue, which this scheme is being charged on, is actually shared by the three tiers of government. From the documents that I have read, there is no state representation in the committee. Although there's a line that says that the Minister of Finance can add as many people as he or she deems fit. One of the challenges is that by the time we get to the state level, then we have 36 representatives, and the committee swells up. How much in terms of bureaucracy are we able to achieve because of bureaucracy? But as it is right now, this document doesn't actually provide for representation by either the states or 36 states or the 774 local governments that we have in the country. So maybe a representative from the Nigerian Governors Forum, or maybe the Association of Local Governments of Nigeria, ALGON. But right now, this document doesn't provide for representation for the states and local governments.
Yeah, thank you. Mr. Lofo, you can ask your question. Okay, if it's not there, let's take on Oladimeji Adeboyejo. Oladimeji Adeboyejo, you can unmute your mic.
Hello? Hello?
I hear you.
Hello, can you hear me?
I hear you.
Okay, thank you very much. The MPR 11% plus 2%, is it a one-off interest payment? Means that at the end of the valuation, when the certificate is issued, to get that amount. If that is the case, then how do you now measure the instrument when it is listed in stock exchange, and what would be the benefit to someone trading on it? Because except if it is not a one-off. My second question will be around, this is a cash advance to government, which is similar to overpayment of tax. And I know in the Financial Acts now, when you overpay your tax, you also have an interest rate of, is it 1% or 0.something% interest income that government is supposed to give you. Can this also apply to that outstanding balance that has not been utilized as to defray your tax? Thank you.
Okay, so first of all, it is a single year uplift, meaning that it is a single uplift, meaning that it is a one-time thing. It is not an annual thing. And I guess it will work similar to treasury bills that are discounted, on purchase. So typically, if you want to buy a current treasury bill, you buy a face value, and then there's also a settlement amount. And I guess that is how this kind of instrument is going to work or trade on the exchange. So it's a one-time thing. You're not going to get annual interest if you've not utilized your credit. So like I said initially, if you have 1 billion euro investment, you get your uplift of 13.5%, and that's it. That's the value of the certificate. And then when you're listing it on the exchange, based on the forces of demand and supply, right, it will determine the price that those kind of instruments will trade at. But typically, they're likely to trade at a discount. So the real question will be, how steep would the discount be? Would it go lower? Would it go higher? But the truth of the matter is, once it becomes a trading instrument, it creates a new world of activity. Because for one, the financial market participants have more instruments that they can buy and sell within themselves to even create economic activity. In terms of the Finance Act that you mentioned, I think the Finance Act mentions early payments, not overpayments, and I think the two are not the same. And so this is a very distinct scheme from the early payment provisions made in the Finance Act, and so I do not think it would be good for us to read the provisions of the Finance Act to apply to this scheme.
Okay, thank you for that, David. Do we have any other questions?
I don't know if Adeboyejo has another question, because I know I've lowered his hand, but he seems to raise it again. So maybe we want to give him the floor. I think Madam Olofoyoku is back.
Hello.
Yeah, we can
Hello.
hear you, madam.
Okay. My question is actually about the trading of the tax credit certificates. It's like, can you shed some more light on the benefits to a buyer if I'm going to buy somebody else's tax credit? What am I supposed, apart from, if you, like you said, it's going to be trade, you are suggesting is something that is going to be traded like the treasury bills or the promissory notes. Maybe for the banks it might be beneficiary to them because of the discounted rate, but as a company, why would I want to buy somebody else's tax credit? If I have my cash, why can't I just pay my taxes direct? And what do I need to trade in somebody else or trade in with somebody else's tax certificate? I don't know. Can you shed more light into that?
Okay, so basically, typically, this kind of credits will be traded at a discount, meaning that the face value of the instruments will be different from the amount you pay for it. So, for example, if you have a tax credit of 1 million in face value, you probably will buy that for maybe 900,000. And so you pay 900,000, but you get 1 million in terms of a tax credit. So it's beneficial to a buyer because you are able to settle your taxes for a cheaper amount, right? So you will not pay higher than 1 million because that's the face value. But you might be able to buy a 1 million tax credit at an amount that is lower than 1 million. So maybe 950, maybe 980, maybe 900,000, but definitely not the face value.
Okay.
I hope you understand what David just said, madam, because what is there is the purpose is to, one, make tax credit attractive, make the scheme attractive to people. That is why one of the things they said is that they can be traded, and for it to be traded, it means that the person who wants to buy must be getting value for what he's buying, which means that I want to pay a tax of 1 million, right? And I have a certificate that I can use to offset that liability that I have, but I'm just paying 900,000 for that certificate. So, for cash management purpose within my organization and for cash flow, of course, you will see that, for finance, the finance expert and the CFOs is a route that they want to take and they want to advise their board or their CEOs to take, because of course you have some savings doing that, basically. Thank you, David, for that. Have any other person? No other person. Okay.
Okay, so there are some comments in the comment box.
Oh, okay.
Somebody says another challenge is that hope the same projects that are done under this scheme will not be presented to be part of the budget later in the future. So the truth of the matter is, as I always say, governance is not only about the people leading. The citizens also have an active role in governance. So we also have a responsibility to monitor budget development and budget implementation. And I guess this is going to be one thing that that the citizens will need to be able to follow up on, to be sure that there's no duplicity of projects.
Okay, thank you. We still have one person raising hand. That might be the last. I think so. We can have the floor. That might be the last question we're taking on this.
Hello.
Yeah, you have the floor.
Hello.
Hey.
Okay, thank you, Mr. Sherman, and our facilitator. Still talking about the MPR and capital market. When, as an individual, why would I want to buy it when I cannot get my cash and I don't have a company to offset the traded instrument? And secondly, how do we still measure this? Because when you look at treasury bills, it has tenure. But when you are looking at this, it does not have a definite tenure, except you now want to start estimating it. That, okay, I'm going to use this credit note in the next 3 years. This is how much I can buy it. But I'm looking at a scientific way in which we can all measure it and arrive at the same thing, when it does not have all the indices that treasury bill has for you to measure it correctly and fairly. Those are my follow-up questions. Thank you.
All right. Thank you, Gareth. In addition to that, before the facilitator answer, if we look at MPR rate, which is about 11.5, then the notch up that the government is doing is 13.5, 2%, making it 13.5. Now, and we make it blanket. I want to believe that probably that rate should be per annum, because if it's blanket rate, so what happens to somebody who spends 1 billion, right, on a project that takes 4-5 years to fix, right, and another project that just takes 1 year to fix? So if you have a blanket rate, so the 13.5% is spread over 4 years for the in scenario 1, and it's spread over just 1 year in scenario 2. Then it's going to bring a lot of disparity in how things, especially like what Oladimeji said, on valuation as well, right? So probably you may want to share light on that as well. Thank you.
So the first question I would be answering is, why would somebody invest in this scheme? And one of the easy answers would be, take pension funds, for example, that have a lot of capital to deploy, but are currently buying treasury bills that are maybe 2%, 3%. In fact, last year we even saw treasury bills doing below 1%. At 13.5%, this is a very attractive instrument for a pension fund, for example. So within their regulations, the pension commission might be able to say, okay, this is an instrument that you can actually, buy. And compared to the current treasury bill market, 13.5% is a very good right now. Right now, the emphasis on right now. So that's why you buy it. And as we had said earlier, why would you sell, or why would somebody else buy a credit that somebody else has, has invested in? Is because you get a higher amount by paying less today. And so that's the value in it. On the 13.5% being spread on a contract that is for more than 1 year, how the scheme proposes that it will work is that every year, if you're doing a 1 billion project, every year the value of work done will be certified, and then a 13.5% uplift will be applied to that annual investment, and immediately it is applied to that and you get your certificate, it automatically becomes a trading instrument. So you do not necessarily have to hold or wait till the completion of the project to get the value for that tax credit. So immediately you do your work on an annual basis, the work will be certified, and then you get your tax credit, and then you can begin trading it or claiming it back from your CIT returns. In terms of measurement, I said earlier I was a financial reporting expert, but one of the things I know is that there's a way to measure instruments that have a certain cash flow into perpetuity, and so maybe that's the kind of measurement techniques that we'll use to measure this kind of item. But like I said, we also need to consider whether we're looking at it as a financial instrument or a deferred tax asset, because those are key things that would help us know how to classify them in our books. But I think this is more on the financial reporting side, which I do not think I am sufficiently qualified to answer.